Welcome to the Market Mosaic, where every week we are taking a look at the intersection of macroeconomic data, stock market technicals, and market internals, things like breadth and sentiment, to formulate a view of where the market could be heading over the near term. This week, let's talk about October and October's hard-earned reputation for volatility. And this year so far, it's looking like it's no different. The stock market is testing key support levels, and we're seeing volatility spike to the highest level since the start of the trade war. Now, the initial pullback for the S&P 500 as it started to come in off record highs, the big driver was trade war headlines. China announced new export controls on rare earth materials. President Trump hit back with threats of another 100% tariff on Chinese imports. And that sparked a single-day decline of 2.7% on the S&P 500. That was the largest daily decline since April. And volatility was also amplified last week on a big sell-off you saw in regional bank shares. So concerns over regional banks have lingered since March 2023. They haven't really completely gone away. Back then, we had a growing bank crisis surrounding unrealized losses on Treasury securities. That led to several bank failures in the U.S., including Silicon Valley Bank. We ultimately saw the demise of Credit Suisse that was acquired by UBS. Well, you still have liquidity concerns in short-term funding markets, but now you have growing concerns about loan losses at several large regional banks. And so that led to a big decline in bank stocks, including Zions Bancorp, that lost 13% in this single session. And so all these events came together, helped the CBOE's volatility index, the VIX that you can see on here. It's sitting above a key level for the first time since May. So this 22 level, shown with this shaded area, this 22 level has held on any pullback since May. And it shows that the bears, ever since this rally started after the trade war in early April, it shows that the bears are having a really hard time sustaining any downside momentum. But that's maybe changing if we see VIX hold above this 20 to 22 area. And we'll talk about that more here in just a moment. But this low, volatility environment, so you can just see how the VIX has a long-term average at the 20 level. You can see we've been below, in some cases, well below the 20 level on VIX since this rally got underway in early April. And since then, that's coincided with a 117-day stretch in which the S&P 500 hasn't even moved below the 50-day moving average. But things are getting interesting this week. It's because the S&P is testing a key chart level on several occasions over the past week, and volatility metrics are holding above levels that could draw more selling pressure in the near term. So this week I want to look at the potential for the S&P 500's pullback off the record highs to become something more serious, and where we could see selling pressure originate. And we'll also look at signs of stress in credit markets, but also signs that the economy is actually holding up quite well as the U.S. federal government remains in a partial shutdown. Let's start with the S&P 500. Ever since crossing back above the 50-day moving average at the start of May, so this black line's the 50-day moving average. In early May, you had the S&P 500 crossing back above as a rally got underway after the initial rounds of the trade war. You can see the S&P's had a steady grind higher. Any pullbacks have been modest, at least until last week. The S&P hadn't even tested this 50-day moving average. But now we can start to see some key levels emerging on this pullback. You can see in this chart that the S&P has tested price near the 50-day on about 4 occasions over the past week or so. It's also carving out a support zone to watch on price. This 6550 to 6600 area on the S&P right here. So these are the low points on these daily intraday bars. That's that 6550 to 6600 area. Look, the S&P, it's not a big pullback so far. We're only 1.3% off the prior record high, but this price area, and since it's right around the 50-day moving average, that will be a key to watch for more near-term price weakness. If we see a sustained move below that level, look out below. Volatility levels last week jumped to their highest level since April. We had the VIX increasing to 29 intraday before reversing lower. And we can also look at the volatility of VIX itself. So VVIX tracks the volatility of the VIX, and the reason why you want to watch this is because it will often lead spikes in the VIX. It's almost like a leading indicator for volatility. And the chart on here shows VVIX. And last week we had a close at the highest level since April 11th. The highest level since back here April 11th, as this came back in following the big sell-off, and S&P ultimately went into bear market territory around the trade war. And so we're tracking key levels on the S&P 500 for more signs that there could be more volatility ahead. If you see this continuing to jump higher, we had a reversal on Friday, but you can kind of see a low right there. This series of higher lows intact. So this low right here around this area, around this 110 area, will be key to watch. Because on the flip side, there's important levels to watch here with VVIX. And if you start to see it drop below this 110 level, what I would watch on here is VVIX around 110, and I would watch the 20 level on VIX itself. A move below those levels could keep volatility targeting funds at bay and limit selling pressure from those strategies. Those strategies use volatility kind of like they look at their portfolios through the lens of a risk budget, when they got to stay within that budget while stocks are very volatile. And when volatility increases, in order for them to stay within their risk budget, they need to reduce stock market exposures. That's how rising volatility levels can lead to more selling across the market. If we see this come in, if we see VIX again drop below 20 and this come back in below the 110 level in VVIX, that could be a sign that volatility is abating and it could limit selling pressure from those strategies. We can also track high yield credit spreads for signs of stress across the markets. So what do spreads do? They measure the cost for high yield issuers, high yield debt issuers, to borrow above and beyond the cost of debt for a risk-free security like U.S. Treasury securities. And so that's what that blue line on here is tracking. It's tracking that spread, the cost to borrow above and beyond a safe asset, in this case, a U.S. Treasury security. And so you can see that spreads right now, they're starting to rise from a historically low level. This is where we're at right now. If I took this chart way back, you'd see this is at the low end of the historical range. But overall, spreads, they remain contained relative to other sell-off events that had a big impact on the stock market. So here's the spike in spreads into the initial rounds of the trade war and the sell-off in early April. Here's another spike in spreads. This was back at the start of early August 2024. That's when the yen carry trade unwind was impacting global markets. So overall, again, spreads remain contained right here. What I would watch for is if we start to see a move in spreads above this 3.5% level. If we start to see a move in spreads above this 3.5% level, that would signal growing concern among high yield investors, and that would likely happen alongside a steeper sell-off in the equity markets. Regional banks have been back in the headlines. A new wave of concerns is hitting the sector. We have fears over loan losses that sparked a pretty sharp sell-off in bank stocks. Namely, you had Zion Bank Corp and Western Alliance Bank Corp coming out with disclosures. One instance of fraud, another instance of just not being able to cover money that was lent out. And so we're seeing credit losses there. The S&P's regional bank ETF lost 6%. Actually, it was over 6% in a single trading session last week. And JP Morgan CEO Jamie Dimon commented that when you see one cockroach, there are probably more. So he is warning that there could be more credit losses, sizable credit losses lurking in bank loan portfolios. But at the same time, here's something that really hasn't gone away. This chart shows unrealized losses, gains and losses on investment securities. Right now, banks are sitting on $395 billion of unrealized losses on investment securities. Now, what these really represent is mostly treasury securities that are held as reserves on bank balance sheets. So, the reserves are parked into treasuries to earn a yield, and treasuries are considered safe capital, so that applies to their capital buffer. But we've had, over the last several years, as these losses grow, this period in time coincide with a big jump in interest rates. When interest rates are rising, bond prices fall, and that is a big contributor to these unrealized losses that are sitting on bank balance sheets. And so the developments around the trade war, government shutdown, that's dominating the headlines, but this could be a sleeper catalyst right here. The combination of credit and liquidity concerns facing banks That could emerge as a big catalyst for volatility if we start to see those fears get out of hand. All right, the government shutdown is entering the 19th day. It's becoming the third longest shutdown in history. For investors, there's two things you're really monitoring. The shutdown can impact the stock market through two avenues. One is that the shutdown is estimated to cost the U.S. economy $15 billion for every week that the shutdown persists. That amounts to a hit of about 0.2% to GDP every week. But at the same time, key government reports covering a variety of economic data, those are not being released during the shutdown. So everything from inflation reports to payrolls in the labor market to retail sales. And so this is where you want to keep an eye on alternative sources of data to track the health of the economy. And for the most part, I would argue the weight of the evidence points to the economy holding up. So one thing I'm looking at is the Johnson Redbook Index. It's shown on this chart. This is a weekly indicator of U.S. retail sales growth. Now, here's the thing. It tracks same-store sales for a sample of just general retailers, but it represents over 80% of the Commerce Department's equivalent their official retail sales data. So it's a good way to gauge, what we would be seeing from the Commerce Department if they were releasing data on retail sales. But we can see this is the year-over-year growth. The retail sales continue. This is reported weekly. We don't have to wait monthly for this. This is reported weekly. Retail sales growth continues running in this range that it's been in since 2024, right around this 5% level. All right, so big week ahead for earnings. We are now firmly into earnings season. 90 companies in the S&P 500 index are reporting this week, and here is just a sample of a few of them. We're going to get names like Netflix, 3M, Lam Research. That'll be an important one to watch on the semiconductor side. Intel, another one on the semiconductor side. So, a variety of companies covering numerous end markets, industrial, semiconductors, and so on. Also have Tesla out this week. And so big week for earnings. Earnings season is underway. Pay close attention to guidance and the outlook and how maybe some, if there's lingering trade war uncertainties or any comments around the government shutdown that could be impacting companies' financials. With earnings season underway, it's important to look at where the growth projections are going to start to fall because, look, we know this has been a market dominated by the Magnificent Seven companies. Companies like Tesla, Apple, NVIDIA have absolutely dominated the return contribution to the S&P 500 since this bull market started back in late 2022. Well, why are those companies dominating? It's because their earnings are dominating. They have driven the earnings recovery since then. A good thing that bulls want to see right here is that earnings growth contribution. You want to see that start to broaden out. So that's what this chart is showing. Earnings projections over the next several quarters, over the next 4 quarters or 5 quarters into late 2026. And it separates the earnings growth out from the Mag 7 versus the other 493. And what you want to see is this trend. You start to see as we get into 2026, this contribution from the other 493 starts picking up, or at least the rate of change in earnings growth starts picking up. Not quite catching where the Max 7's at, but again, you want to see, if you're going to see the rally broaden out to other stocks, those stocks need to be supported by the earnings outlook. So important to watch the earnings growth in the other 493 right here. All right, one trade to keep an eye on this week is with Tesla. Let's look at Tesla's chart setup because this is a great setup in a widely followed stock. So Tesla ran up, peaked near the 490 area. This was back in late 2024, initially in late December. Peaking around that 490 area, pulled back with the rest of the market into early April during a trade war-driven sell-off, and then has been slowly making a recovery. Rallied, trading in a pretty tight range for a while, and then we had a breakout over this 350-ish area from this ended up looking like a symmetrical triangle, which tends to be a continuation. Broke out, took it right up back to the prior highs near that 490 level, and now look at what's happening. We're getting another smaller pullback. This is trading in a really tight range. We're getting a bullish MACD reset above the 0 line, so we're seeing a bullish momentum reset. The RS line's holding up, so what we want to watch for is for this stock to break out over the 490 level, And you want to see that happen on rising volumes. So this bottom panel down here is a way to visualize where volume's at relative to the average. This looks at the standard deviation of volume, and maybe we have a catalyst this week. We know Tesla is reporting earnings this week, so look for that earnings report as a catalyst to drive a breakout in the stock. All right, that is all for